Welcome to Talk Tickers. Today we are digging into a real head-scratcher from the semiconductor giant ASML. They just dropped their Q4 and full year 2025 earnings, and while they posted some absolutely record-shattering orders, the stock, well, it ended the day down. So what's going on here? Let's get into it. Okay, let's just jump right into the big paradox that had the market buzzing. ASML puts up these monster numbers, just incredible orders. The stock shoots up more than 6% before the market even opens. But then, by the end of the day, it's down over 2%. So what happened? How did all that good news just fizzle out? That's the real story we need to unpack. To really get what happened with the stock, you have to start with the numbers themselves. And honestly, they were sending some seriously mixed signals.
Now, just look at this for a second. The revenue, a nice little beat. Fine. Earnings per share, a slight miss by about 20 cents. Again, nothing to really write home about. But then you get to the net bookings, the new orders. Analysts were expecting something around 6.3 billion euros. ASML came in with 13.2 billion. That's not just a beat, that's a completely different reality. It's more than double what anyone was expecting, and it's the loudest signal you can get about future demand.
And that absolutely massive bookings number, well, that's where the real story is. It created this huge tension, this fundamental conflict in the market's mind. It's basically a tug of war between overwhelming AI-driven demand and a real fear about whether ASML can actually build machines fast enough to keep up.
So on one hand, you have this incredible bull case, right? The AI supercycle is the real deal. It's pushing giants like TSMC and Samsung to order like crazy, and it's ballooned ASML's backlog to a staggering 38.8 billion euros. But on the other hand, the market is worried. I mean, these are arguably the most complex machines on planet Earth. The fear is that the company just cannot physically ramp up production fast enough to meet this tidal wave of new orders. It's a classic good problem to have, but it's still a problem. And that's exactly what made all that early optimism just evaporate.
But in the middle of all this doubt, the CEO, Christoph Fouquet, was crystal clear. He looked right at the market's biggest fear and said, point blank, we are not the bottleneck. Certainly not this year. I mean, that is management drawing a line in the sand. The next few quarters are now a direct test of that promise. It all comes down to their ability to execute.
So, how are they planning to prove they can actually deliver on all this? Well, it really comes down to two big things: their official guidance for the year ahead and a pretty significant internal shakeup that's designed to make them a whole lot faster.
First off, how's management backing up all that confidence with some really strong guidance for 2026? They're projecting revenue between 34 and 39 billion euros, a range that, by the way, landed comfortably above what most analysts were hoping for. But it's not just about the top line.
Nope. They're also targeting a really profitable gross margin of around 52%. So they're saying this growth isn't going to come at the expense of their profitability. And just to put a cherry on top,
They announced a new 12 billion euro share buyback. That's a huge signal that they believe in their own future cash flow and they're serious about rewarding shareholders. It's really a three-part message. We've got growth, we've got profits, and we've got confidence.
Okay, this is a really key point. You might have seen some headlines about job cuts, but this is not about saving money. It's a strategic reshuffle. They're cutting layers of management to create more hands-on engineering roles. The whole goal here is to, as the CEO said, boost engineering capability and just get the bureaucracy out of the way so their smartest people can innovate faster. This is their answer to the big execution question.
So let's put it all together. You've got record-breaking demand, you've got the market's fears, and you've got management's plan to deliver. So, what's our takeaway? What's the next call for ASML?
Okay, here's how we see it playing out. First, our prediction for next quarter. The numbers will probably be strong, but honestly, no one's going to care about the numbers. All eyes will be glued to management's commentary about how they're ramping production. Second, the stock itself. Expect it to stay volatile. This tug of war between demand and delivery is not over. And finally, our rating, outperform. Why? Because this AI-driven demand isn't a one-quarter thing. It's a multi-year tailwind that in our view is just too powerful to ignore and will ultimately outweigh these very real, but solvable, questions about near-term execution.
So, that's the story behind ASML's very confusing earnings day. Thanks for watching this Talk Tickers Explainer. And a quick reminder, this is not financial advice.